This video is part of the Beginning Farmers Demand webinar series. Thanks, John, for having me. My name is Florencia Colella. Today, we are reviewing the basics of accounting and record keeping. So the second step in the record keeping workflow is classifying transactions. Let's discuss a bit more the chart of accounts and the categories comprised in it. So there's this saying from a farm accountant: it takes a computer to make a real mess of things. If you've got a chart of accounts that creates a 6-page report, your chart of accounts isn't working for you like it could. A user can accomplish managerial accounting objectives with a wide variety of software packages. And similarly, a user can do a poor job in any system, no matter how simple or complex the system is. One of the important components of creating an accounting system that works is to create and review the chart of accounts. The chart of accounts has to reflect the transactions that you will be posting in the system. A standard chart of accounts has accounts that will comprise the income statement. So those are revenue and expense accounts, and the accounts that will make up the balance sheet, which are asset, liability, and equity accounts. So income statement accounts could be revenue accounts, which represent revenues from the different enterprises, production expense accounts, which would represent the production costs for the different enterprises, operating expense accounts, which represent the expenses associated with producing revenues that are not production related. They are identified in 4 major categories: sales expenses, which are expenses related to a specific sale transaction, marketing expenses, which are expenses that are not related to a specific sale, freight expenses related to the transportation or of finished goods, and general and administrative expenses. Other accounts represent revenues and expenses not related to operating activities, but more to financing or investing activities. For example, income or expenses on interest, dividends, and asset sales would go to the other accounts account or accounts. And then there's income tax expense accounts that represent the actual and deferred income tax expenses. Balance sheet accounts comprise current asset accounts that represent cash or items that can be converted to cash or used up in the normal operating cycle of the business. Inventory accounts, which are also current asset accounts, but are identified separately because of their importance, and can be divided in 3: raw materials, work in process, and finished goods. Non-current asset accounts, which would represent all assets that do not meet the definition of current assets. These are assets that have a life of over 1 year, such as machinery, breeding livestock, land, buildings, and land improvements. Current liability accounts represent those amounts whose liquidation would require the use of existing current assets. Non-current liability accounts represent debts against non-current assets, such as machinery, breeding livestock, land, buildings, and land improvement. Owner equity accounts include contributed capital, current year net income or loss, and retained earnings, which represent the accumulation of your income and losses over the time the business has been in operation. Okay, so then the third step in our workflow is storing evidence. If your farm gets audited by the IRS, they will want to see your books and the receipts that support the information entered in your books, among other things. So you need to try and have a method in place. Your record-keeping system has to have 2 things: a process to archive receipts and a process to record transaction information. Which comes first, or are these independent processes? Should you just collect receipts and then transcribe that into your record keeping system? Well, let's look into it. For each transaction, you will need to record the date, the amount, the account, the vendor or payer's information when applicable, check and deposit numbers, and descriptions. Receipts may help recall some of the transaction information, but they may not have everything you need. So you shouldn't rely on receipts alone to build your transaction list. Specifically, you need to know what account to assign the receipt to, which may be hard to tell or recall by the information included in the receipt. You may be thinking, well, I could just say every transaction at a XYZ store is always going to be repairs. But a specific store you buy from or buyer you sell to will not always be a certain indication of what account the transaction is associated with. The day will come when you will find that you will buy feed instead of repair items there, and it will get misassigned, or one transaction may need to be split among several accounts. That's why using receipts alone is not sufficient to build up your records. Sometimes you might not even get a receipt, right? So if you are going to partially rely on receipts to build your transaction list, you need to make sure to write account information on the receipts or put them on dedicated envelopes for each account. You'll also need a dedicated notepad to jot down any transactions that you don't have a receipt for. And you will also have to remember to print any receipts from online transactions if you have those. Some people put everything on paper, receipts, notes, etc., and then move it into an archive drawer or accordion binder by category once transactions are entered in the record-keeping system. Others use a digital receipt and note archival system with a folder structure by account. Some cell phone applications that can be used to capture snaps of receipts and save them to folders are Google Drive, OneDrive, and Office Lens. And there are many other scan-in apps. Just make sure to keep receipts separate from other photos. If you choose to use an electronic receipt storage system, you may destroy the original hard copies. Always remember to include copies of receipts from online purchases in your digital folders also, and make notes of anything that you don't have a receipt for. So whether you are a paper person or a digital nerd, please know the difference between an invoice and a receipt. Some people like keeping invoices. That's fine. But if you do that, attach the receipt to it, as invoices do not serve as proof of payment. Now, building your transaction list will be easier the more often you do it. We hope that by now you are convinced that the bank statement cannot be your source of information for your records, as mistakes do happen there, and they also don't provide account information. The same goes with any uncategorized receipts. There are plenty of options to build up your records, from simple to portable to powerful. So here's a quick overview. There are paper options. Some are free, some are paid. This is the picture from the Farm Records book, which you can buy from the MSU online bookstore or your local extension office. And there's applications you can download on your phone. Again, some are free, some are paid. Here's a few examples of free ones. There's websites. Some are free, some are paid, like QuickBooks Online, for example. And then there's combinations. Most apps will have a website too, for example. And there's spreadsheets. Some spreadsheet softwares are free and some are paid. And here's a few examples of free record-keeping spreadsheets of different kinds. Finally, there are computer softwares, which are always paid. This is a picture of QuickBooks. So some of these options have the ability to export into spreadsheets if you want to personalize reports a bit. Some even have the ability to store receipts and extract information through text recognition. So finding a record keeping system that fits your needs should be fairly straightforward once you know a bit more about each option. Having a good chart of accounts, though, is the key to happiness in any system you choose. So make sure to spend some time on that before even considering record keeping options. In that sense, Corey Clark is going to be speaking about taxes, and knowing what you need to report for taxes is a great way to pick good accounts for your chart of accounts. Also, MSU has the Telfarm program, which is a paid program that gives you a standard chart of accounts that you can use. Using this chart of accounts makes it really easy to get a standard analysis of your business at the end of the year, which a farm business management educator like John Laporte or myself can do for you. And then with several people using the same chart of accounts, that also gives you the ability to benchmark. This is to compare your results with average results from other farmers and get an idea of where your farm is at with respect to everyone else. The Telfarm program also will review your books and back them up throughout the year, and they can also do a year-end tax plan for you. So it's pretty awesome. Anyways, your records can be great or terrible, independently from the complexity or the price of the record keeping system you choose. It is up to you and your commitment to inputting the data on a timely basis. And any system you decide to use will have a learning curve, so make sure you save time to learn. Another thing you should consider doing is using a competent accountant and discussing your options with them before making any decisions. Apart from satisfying potential IRS audit requirements, keeping records will allow you to budget, communicate with funding and lending organizations, and analyze virtually anything in your farm, even productive matters, and make truly confident decisions. You can achieve this powerful goal by simply recording transactions and then summarizing them. So it should be easy. And here we are to help you out as you do it. So finally, we need to go back and balance and reconcile. That's the last step of keeping records. So let's talk about account balancing and reconciliation for a minute. Bank reconciliation is needed to ensure that your checking account balance is correct. Balancing is needed to verify that your records as a whole are correct. So balancing is an internal process. If you are using an Excel record keeping system, you need to make sure it balances with each transaction you enter. Otherwise, chances are you're just doing it wrong. Computerized systems, on the other hand, are designed to stay balanced automatically. To make sure your accounts are balanced, add up your assets, subtract liabilities and equity, and you should get a zero balance. Equity accounts will have any owner contributions minus any owner draws plus net income, and they roll over from year to year. Reconciling is a process that involves records from another party. How many of you actually still reconcile? There's a large group that will argue that I need to get with the times. This is the 21st century. Modern technology has advanced far beyond such trivial process. Unfortunately, that's not always the case. We still have human inputs that can cause mishaps. Errors do happen. Checks get lost in the mail, online orders disappear, an unexpected bank fee that you didn't account for, a wire transfer that did not get completed, checks that are outstanding and need to be addressed. And these are just a few examples. There are also inventories that need to be reconciled, such as grain produced and sold. One of my favorite reconciliation stories comes from an extension educator who conducted a reconciliation of grain sales for a producer, which basically is, it looks at what grain is in storage, what was harvested, and it makes sure that everything matches up. Well, she found thousands of bushels of grain that were unaccounted for. The farmer was absolutely shocked and a non-believer at first, but after finally agreeing to contact the local elevator, he discovered that he indeed was sitting on a pile of grain that was racking up storage costs. How long would that grain have been there before being discovered if they wouldn't have been making a reconciliation. So I recommend that you reconcile bank balances. I also recommend that you reconcile your production inventory if you are selling to an elevator, a cooperative, or a processor. And finally, I recommend that you reconcile your accounts receivable from clients and your accounts payable and prepaid expenses to your vendors. Hopefully, this way you can catch mistakes that would have otherwise gone unseen. This also makes for easy and accurate year-end adjustments for your production inventories, prepays, and accounts payable and receivable. So reconciling an account involves comparing some external source of information with your own. The purpose of doing so is to locate any differences between the two versions and to spot and correct any errors made either by the other party or you. This can be done as often as daily if you have your bank's app on the phone and you are methodical about it. Or you can wait for the monthly bank statement and do it then. The more often, the less daunting, especially when you start racking up lots of transactions. Inventory, accounts receivable and payable, and prepays can be reconciled once a year. But you have to have any statements or records needed to be able to do it then. So make sure you keep those somewhere as the year progresses. The process will usually involve 2 lists of transactions and a way to check or cross off records that match up. So reconciling accounts will keep your books in check, as well as your relationships with financial institutions and other business partners. This is why and how you reconcile your accounts. Okay, so by doing these 4 things, you will be able to know where you are and make all sorts of decisions that take you exactly where you want to go. So thank you everyone for listening. Thank you, John, again for having me, and we'll see you in the next video.